Good evening. My name is Rasheeda, and today I am presenting a time series analysis of the U.S. labor market for data 625, spring 2026. My research focuses on whether economic indicators suggest a long-term shift in unemployment or a stabilization following the volatility of the early 2020s. Moving to our primary time series, we are looking at the monthly U.S. unemployment rate from 2005 through early 2025. As you can see by the annotation, the most significant outlier in this 20-year span is the April 2020 peak, where unemployment reached an unprecedented 14.7% due to the global pandemic. Since then, we've seen a remarkable recovery. Note the linear trend line here. It has a p-value of less than 0.0001, which confirms that the overall downward trajectory we've observed is statistically significant and not the result of random noise. For context and to provide a complete picture, I analyzed three additional variables. So first, there was non-farm payrolls, which shows the total strength of the workforce. Second, total unemployed persons, which gives us the raw count of individuals looking for work. And finally, initial jobless claims, which acts as a leading indicator of new unemployment. By looking at these together, we can see that while payrolls have grown, the spikes in jobless claims often precede broader economic cooling, which is a trend I'm monitoring today closely for the 2026 outlook. Now, let's look at the Tableau forecast. I utilized Tableau's default exponential smoothing model to predict trends into 2026. The forecast suggests that the unemployment rate will remain around 4.42%. I want you to draw your attention to the shaded funnel surrounding the forecast line. This is the 95% confidence interval. While our best guess is the dark line, the shaded area represents the statistical range where the actual values are likely to fall. So my confidence in the forecast is high for the short term, though the widening funnel reminds us that long-term predictions always carry inherent economic risk. In conclusion, the data indicates a labor market that has proven resilient. For my portfolio as a data professional, this analysis underscores the importance of using multiple variables to validate a primary trend. My data was sourced from the Federal Reserve Economic Data Repository, and my methodology follows principles outlined in our course by Joshua Milligan. Thank you so much for your time.